Hey guys, welcome back to the channel. Today I want to address a very big issue that's happening now with Teamviewer, which has dropped almost 50% since in the last week pretty much. And I want to address the issue, why did this happen, and if you are an investor in Teamviewer, should be worried or it's nothing to be worried. So I done a lot of research for this video, so make sure to stay till the end, and also like, subscribe, and all the good stuff. So let's begin. Okay, so in the last week have a massive drop from 28 to 13. So basically we are 50%. Overall the market didn't like since the beginning of the year it's dropped like 70%. So the market this year didn't like too much this stock, and there is few reasons why. First reason which I want to address is the last week 50% drop, and it's all resumed to this statement here. Basically they lower their expectation, they lower the profit, they lower the growth. So basically there'll be slow growth. These numbers looks good, and these numbers looks kind of bad. So they lowered their EBITDA margin to 34%, which if we go down here, previously they was expecting for 2021 about around 49 to 51. So now it's 44 to 46. So basically a 5%, let's say 5 to 6% EBITDA lower from they was what was previously thought about. Still I think they hold strong to their 1 billion in revenue by 2023, and after that at 25% grow after 2023. So this is the only thing, EBITDA. So yeah. Okay, now I want to I try to evaluate this stock, so you can have an idea of what so how can I explain it? So basically how I evaluate the stock, it's most likely to discount cash flow or discount free cash flow, basically, which is mean we're projecting out future cash flow that the business will make and trying to discount it at today values, because let's say for example $1,000 or £1,000 in the future will worth less than £1,000 pounds today, right? The same was like 10 years ago, like £1,000 10 years ago was worth more than £1,000 today. So basically this is the whole principle. Now this is a normal discount free cash flow, which it's showing here in English pounds, but it's pretty much US dollar, everything, the number is the same. Okay, so in 2020 they basically made 198 million euro, because Teamviewer is in Europe, and they make 198 million in free cash flow. Normally I did pull up this number from finance, Yahoo Finance. If you go here, cash flow, go to the bottom, 198 million free cash flow. And basically cash flow, it's cash from operation minus capital expenditure. And I double check this number with their own financial statement, what they're showing, because I want to be accurate. So so this was the financial statement in 2020. So it was 224 million minus 26 million in capital expenditure, and it's basically this number right over here, 198 million euro. So I start with this starting point, and I add a growth about 10% growth on average to be conservative, and for the next 7 years, as you can see here. So it's 1 2 3 4 5 6 7. For the next 7 years I can go any forward because is what allowed me to do this this software here. So cash, again, I pull up this number here. So those are number that are public available, you can check it by yourself. So they have 466 million in cash and 886 million in debt. So I added right here, and a perpetual growth after these 7 years, because a business it's most likely can't grow forever at this pace. So I'll put 3% growth after this these 7 years, but I think it can grow easily 10 years or maybe 15 years this business, but to be really conservative in case anything can go wrong in the future, right? And as a discount rate, it's weighted average cost of capital. You can Google it and to see what it's about. So this is basically share outstanding. Basically it means all the share available in the market. And another very important thing, I think it's overlooked by a lot of people, this company doesn't issue shares, so doesn't dilute their shareholders. So as you can see here, it's keep 200 millions, and I did way back, so since 2017 they do not dilute their shareholders. They take that instead of diluting you, so this is a good thing. Maybe I can do a separate video about dilution if you don't know what is it, or you can Google it if you want, but I think I'll make another video about what is dilution. So 200 million shares, and this is the price now. It's like 13.78. It's 13 and 18. So basically they come up with a fair value of 54 in this case euro. So the stock is pretty much undervalued by 300%, and I done it with another way. So this is one way to evaluate this stock, and I done it with another way to be sure I'm not getting wrong. So this is another way to calculate their basically their future growth and what you should pay today. And this is what they making now. So they making 39 cents per share trailing 12 months. So is this number here, this is trailing 12 months earning per shares. Okay, so we added here, we add up a 25% future growth on average. It should be, I think should be sustainable, this growth in the next 10 years or so. Minimum rate of discount, this is basically it's a return, but it's a discount, you can take it both ways, a 15%, and a future PE of 35% in so basically on the end of this period the stock should trade at 35% earning, which for this type of company it's pretty, not gonna say cheap, but it's normal. So I give you a comparison, like Tesla is trading at 400 time earning right now. So this is trading even now at 35 time earnings, and I think in the future it should be pretty much the same. So the software come up with this sticker price, basically 31 euro. If you want to make, so basically if you pay this price 31 euro, you will make around 15% return on your money. So in these 10 years you should be able to sell it around 127 euro. But because it's high chance that we can be wrong, the future is unknown for sure, so we want an extra safety measure, an extra caution, if you want to say, an extra discount rate. So if you pay this price today, you should make 15% compounded in the next 10 years, but we want to pay, that's why we want a margin of safety, basically this is called. It's exactly almost 50% from where the sticker price is now. So it say here 16, we should pay 16 euro. So imagine if if the sticker price is 31 euro and you'll make 15% on this price, you should make at least double, right? So you should make around 30% compounding for the next 10 years, which is pretty good, right? So you will you make like 7-8 times your money in the next 10 years, which is astronomically high, to say so. And to be conservative, I'll say like 80-90 euro for the next 10 years you should be able to sell this stock. So I use this like Simply Wall Street, which is they evaluate stock as well. They have all this nice chart, future value, wherever you can check it out, Simply Wall Street. And look what their evaluation come to. They think this stock is 64 euros today, not tomorrow, not in the next 10 years, today. They think you should pay today 64 euros and you'll be fine, you'll make money. So they think it's 78% undervalued, 78%. So they come up even with better number than mine. So I don't know, the takes on I feel it's undervalued. Future growth, this is what their analyst, I never use 35, I use in my discounted here on the free cash flow 10% growth, and here I use 25% growth. So basically they think it will grow at 35% pace, which it's possible, but I think it's kind of a little bit high to grow for such a long period of time. For with 35% it can be possible. Better to be conservative, to be sure that you can make money on this stock. So if you think I missed something, you can let me know in the comments what I missed it, and I don't know, if you have any question as well, let me know in the comments below, so I'll try to answer you. And yeah, this is it for Teamviewer. Thank you for watching, and see you next time.